Are there any other secondary security documents that a lender would normally have in place?
Certainly, personal guarantees have been more prevalent recently as banks have found it more difficult to obtain recoveries in recent years as a result of the downturn in the property market. Where lending to a corporate entity, for example, it is common practice for a director or a shareholder of that company to grant a personal guarantee in favour of the lender. This is particularly the case where a company might only hold one asset and there may be limited appreciable capital value. These PGs, the personal guarantees, guarantee the liabilities of the company to the lender under the principal loan documentation, and they not only guarantee the payment when due to the lender, but the performance of certain obligations under the loan documentation. Personal guarantees can sometimes be backed by additional security. So for example, if that individual holds other unencumbered assets, it may be that the lender chooses to obtain security over those properties or other assets. Grant of those additional securities will allow the lender to sell that property or that asset if the guarantor breaches the terms of the guarantee without the lender having to go through the courts. So personal guarantees are particularly prevalent at the moment in the marketplace. Lenders will often take a personal guarantee to evidence commitment from the directors and or shareholders of the corporate borrower. We may also have a deed of priority where a second lender is involved in the transaction. A deed of priority essentially regulates the layers of finance that have been injected into the project. Essentially, there will be a senior and a junior lender, perhaps both wanting security over the same asset. The senior debt is, generally speaking, but not always, the larger amount being invested. And a deed of priority, in simple terms, allows the senior debt to be In simple terms, a deed of priority allows the senior debt to be repaid first in a insolvency scenario or a default scenario, and then the junior debt will be repaid. Certainly these can be heavily negotiated documents and may be time consuming to get to an agreed form, particularly where the junior lender may, for example, want buyout rights, i.e. the right on a proposed enforcement by the senior lender to buy out the senior debt and step into the shoes of the senior lender. There may also be standstill periods agreed whereby the junior lender is allowed to accelerate its loan on a default scenario under the junior facility once the senior lender has had the opportunity of also enforcing its security. The senior lender may also allow the junior lender certain concessions, i.e. the right to receive payments of interest or capital repayments during the term of the loan, provided there is no event of default continuing under the senior facility. So it can become quite a protracted negotiation period, but obviously beneficial for the borrower because it doesn't just get one layer of finance injected into the project, but the second layer of finance into the project. There may also be a subordination deed. A subordination deed is very common at the moment, particularly where there is acquisition of a property by a corporate entity. For example, a corporate borrower that is non-trading may not have any capital or any other assets, and it may be that the corporate entity has in fact been set up for the sole purpose of holding the property to be acquired. In that case, the directors or shareholders may often inject capital into the project to pay for the shortfall in purchase price of the property. That capital will often go into the company by way of director or shareholder loan, and it's important that these loans are subordinated in favour of the lender, i.e. the director or the shareholder, or both, who have put money into the company to allow completion of the project, will have to be aware that those loans will not be repaid until such time in the future as the lender has been repaid in full, and a subordination deed will document that. There may also be a charge over membership interests. This is taken where a shareholder or director have injected a shortfall of cash into the company for the company to purchase the asset, and that injection of cash is not a loan to the company but a capital investment. The lender may want to take a charge over the membership interests that are acquired by virtue of that capital injection. So the right to receive certain benefits, allocation of profits and dividends, and essentially allows the lender to charge the interest the shareholder may have in the right to receive those benefits while there are debts outstanding to the senior lender. There may also be charges taken over the shares held in the company. This is where the lender may see the need to sell the company with the property in the company. This allows the shareholders to charge their shares that they hold, and if it's a corporate, those charges are registered as against the corporate shareholder at Companies House, and alert any third parties to the fact that there are charges in place over the shares in the company. And in an enforcement scenario, will allow the lender to transfer those shares from the shareholder to the lender itself and sell the shares in the company, with the company owning that property within it. Other ancillary documents which may be taken are a charge over membership interests where the borrower is an LLP. This may be required where the partners of the LLP have invested capital into the LLP, which is being utilised to purchase the asset over which the lender is taking a charge. And essentially it charges any interest the members may have acquired by virtue of the capital injection into the LLP, and the right that is attached to that, i.e. the rights of the members to take certain benefits such as allocation of profit or distribution from the asset. If you've got a limited company as your borrower, you may, instead of taking a charge of membership interest, which is relevant for an LLP, you may want to take a charge over the shares in that company. This, in a worst case scenario, would allow you to, as a lender, to sell the company with the property included in that sale. This is beneficial for a lender because there can be SDLT savings with the sale of the company rather than the sale of the property solely. And often where the company has been set up for the sole purpose of acquiring the property, essentially an SPV, and that is the only asset it owns, borrowers shouldn't be put off by having to grant charges over the shares because they're non-trading and the company holds no other assets.